Under profitability ratios, we examine the incomes and expenses of business and try to determine the profit making capacity. The first in this category is gross profit ratio. Gross profit simply is the margin that the business makes. It is the difference between sale price and cost of goods sold. Second in line is the operating ratio. Operating ratio is a ratio of operating expenses of the business to the sales. This ratio measures the ability of the business to cover its operating expenses using the amount earned by way of sales. The third ratio in this category is operating profit ratio. Operating profit is calculated by deducting only the operating expenses from the net revenue. This figure then is divided by net sales to get an operating profit. This operating profit ratio tells you a pure profit which is earned by the business undertaking only the primary activities of the business. The fourth category in this ratio is net profit ratio. This indicates an overall profit making capacity of the business. We deduct all the expenses, whether operating or non-operating, from the figure of revenue and figure out the net income. This net income, when divided by sales figure, gives us the net profit ratio. Let's do some calculations for the profitability ratios using the statements that we have. So we have the same profit and loss account and balance sheet for the firm, and we are going to calculate various profitability ratios that we just learned. So let's go first to the gross profit ratio, which is simply the figure of gross profit divided by net sales. Now, usually we express the profitability ratios in terms of percentages. They express more in that way, and that's the traditional way which has been followed for a long time to express these ratios. So now let us find out what gross profit is. So gross profit is equal to sales minus cost of goods sold. And then we also need to figure out what cost of goods sold is, which is equal to opening stock plus any purchase of stock plus any direct expenses and minus the stock left over, which is closing stock of the business. All right, this is the other way. Now we can go to the income statement of this company and figure out the amount of gross profit. So here you have been given the amount of gross profit equal to 27,000. It has been calculated for us already, so we do not need to worry about how to calculate this figure. But if that is not the case, you may be given the amount of sales. So you will have to deduct the figure of cost of goods sold from the amount of sales. Now, cost of goods sold would be equal to opening stock plus purchases plus the direct expenses minus the closing stock. So it's the same process. By adding these all and deducting this, you will get the figure of cost of goods sold, which when deducted from sale figure will give you 27,000 as gross profit. However, in this case we have the figure of gross profit, so we'll just use that directly. So you have gross profit ratio equal to 27,000 divided by 120,000 into 100. This gives us a gross profit ratio of 22.5%. Now this ratio indicates the margin of the business. This means what is the difference between basic cost of the products that you are selling and the selling price of the product. This is the margin that you stand to make if you engage in this particular business. Using this margin, you can then go forward and see how much of this margin you can afford to spend on selling and promoting the goods. You can spend on advertising, hiring sales staff, etc. And whatever remains will be your net profit. So higher the margin, better it is for the business. There are no ideal margins in different businesses, but you have to look at industry standards, industry averages to compare the firm that you are analyzing. The second ratio is operating ratio, and it is calculated by dividing the operating cost of the business by net sales and multiplying it by 100. Now, operating cost is equal to cost of goods sold, and we add to it any indirect expenses, but these indirect expenses have to be operating. So I'm going to write operating expenses. So these expenses have to be indirect and operating expenses. So cost of, how to calculate cost of goods sold. Now cost of goods sold, as I told you earlier, is equal to opening stock plus purchases plus direct expenses minus the closing stock. Alternatively, you can also say net sales minus gross profit. Both ways you can calculate cost of goods sold. Let us see which way would be easier. I guess this particular way is quicker. In this case, we have net sales equal to 120,000 minus the gross profit, which is equal to 27,000. So you have 93,000 as the cost of goods sold. Now we can repeat the calculations using the first method as well. Let's see what happens. Opening stock given to you is 15,000. You have purchase equal to 80,000, and then we have direct expenses which are 9,000 each, and then we have closing stock which is 20,000. Let's look at the income statement. So opening stock 15, purchases 80, 9,000 each for wages and factory power. These are the direct expenses relating to production of goods, and closing stock is 20. So the result of this calculation again will be equal to 93,000. So you can calculate cost of goods sold either way. Let's go to the calculation of operating cost now. So operating cost now is equal to 93,000, which is the cost of goods sold, plus we need to identify indirect expenses, but they should be operating expenses. So let's look at the income statement. Now indirect expenses include depreciation, which is operating, fine. Office expenses, salary and carriage, interest expenses, all right, and then you have tax. So these are the items which are indirect expenses, but they are also operating expenses, indirect and operating. So we need to add all these to the cost of goods sold to calculate the total operating cost for the business. So we are going to add depreciation, office expenses, depreciation, office expenses, salaries, and the carriage, and these are the amounts for these items. Depreciation 5,000, 3,000 for office expenses, and 2,000 for salaries, and 1,000 for carriage. The total operating cost is 104,000. Now we have the amount of operating cost, we know the amount of net sales. Let us calculate the operating ratio. This is equal to 104,000 divided by 120,000 into 100. This comes out to be 86.6%. Now this ratio indicates that the operating cost of the business is 86% of the revenue that the business is generating. If you are earning 100 rupees, 86.6 rupees out of those 100 are being spent on just running the primary activities of the business. And still there is there is this interest, there is this non-operating expenses as well, which has to be paid out of the rest of the money that is left with you. So lower the ratio, more efficient the business. The expenses have to be reduced by the business as far as possible. So businesses aim at reducing the operating ratio. Let us now look at the third ratio for profitability, which is operating profit ratio. So simply we divide operating profit of the business by net sales and multiply by 100. So question is, what is operating profit? Now operating profit is equal to sales minus cost of goods sold, all of this part is operating, and minus operating expenses. So all the operating expenses are deducted from the sales, and hence you have the operating profit. In other words, you do not include any non-operating income or expense, and then you get the operating profit. So we can calculate operating profit using this method, or we can use the net profit and add to it any non-operating expense, because we do not want to include it, and deduct any non-operating income, because we do not want to consider these incomes either. So let's take both these methods and see what happens to the operating profit figure. So we start with the first equation here. We have 120,000 for sales minus cost of goods sold and operating expenses. So in the previous ratio we did do the calculations for these two, and here it is. This is the cost of goods sold, 93,000, and we need to add to it the rest of operating expenses, which are added here, and the total is 104,000. So I'm going to pick up this figure here and 104,000. So we have sales minus cost of goods sold and operating expenses. So both these together sum up to 104,000. And out of this, of course, you need to pay taxes. So there is a figure of tax which is 2,000. So let me just say taxes here. All right, now this comes out to be 14,000 here. This is for the first equation. Now for the second equation, you can work backwards by taking the figure of net profit, which is, so let me say this is first approach, and second approach is as follows. You have 13,000 as the net profit, and you're going to add to it any non-operating expenses. There is non-operating expense of interest, which is 2,000. And let's go to the income statement to see if there is any non-operating income. So here you have net profit 13,000, you have interest of 2,000, you have interest on investment, which is a non-operating income. So you'll have to deduct 1,000 as well. So minus 1,000, which gives you 14,000 again. So here this approach and this approach gives you the operating profit figure, which is equal in both cases. So now you can divide the operating profit ratio. Now you can divide 14,000 by the net sales figure, multiply by 100, and get 11.6%. So this basically tells you that the result of your primary activities is a profit of 11.6%. You're not considering any non-operating activities such as interest on loan or non-operating income. So purely this is the amount in the business that you are making. Let's now look at the fourth ratio, which is net profit ratio, and it is as simple as gross profit ratio. You need to take the figure of net profit, divide this by net sales, and multiply by 100. We have done this over and over, and we remember that 13,000 is the net profit figure and 120,000 is the sales figure. multiply this by 100, and you get a net profit percentage of 10.8%. This is the overall profitability of the business, and indicates the return to the firm as a whole, not only the equity shareholders or debt holders, but to the firm in totality.